So in this assignment we will into concept of income tax and try to understand in depth. For this we will look into annual report prepared by Domino's Pizza for its latest financial year, so we can understand how a real life company will account for income tax in their financial statement. And also look into different other different concepts which will help us for better understanding of income tax. Basically, income tax is the amount imposed by government to the taxpayer. The taxpayer can be an individual or a company, but for this assignment we will particularly look into the income tax treatment made by company. So first we will look into different concept that helps us to understand income tax. So first one is accounting profit. Accounting profit is a profit made by any company after deducting expenses from its revenue according to generally accepted accounting principle. The next one is a taxable profit. Taxable profit is a profit made by any company after deducting expenses from its income according to Australian income tax legislation. Temporary difference is a difference that arises due to a difference between the carrying amount of tax and assets with the tax base, carrying amount of assets and liability with the tax base. The next one is taxable temporary difference. Taxable temporary difference is a temporary difference that will yield taxable amount when determining when in the future when determining tax payable or loss. Deductible temporary difference is a temporary difference that will decrease the income tax payable in the future when the carrying amount of tax and when the carrying amount of assets and liabilities are recovered in the future. And so another one is a deferred tax assets and deferred tax liabilities. Deferred tax assets reduces tax payable in the future. It occurs when the tax base of assets is greater than the carrying amount, or when the tax base is exceeded when the carrying amount of liability is exceeded by the tax base. Deferred tax liability is a liability to company and is amount that is paid to amount to be paid to the government but has not been paid yet. It occurs when a business earns a certain income which is different from the taxable amount in the tax return. The next one is a recognition criteria of deferred tax assets and deferred tax liabilities. Deferred tax assets is recognized for all deductible temporary difference, and to the extent it is probable that the taxable profit will be used against which deferred deductible temporary difference will be utilized, or when there will be a recognition as a liability from transaction which doesn't have any business combination, or when the transaction does not affect accountable profit or the taxable profit. The next one is deferred tax liability. Deferred tax liabilities will be recognized for all temporary taxable difference to the extent that it is due to the initial recognition of goodwill, or recognition of assets and liability from the transaction that is not of a business combination, or that doesn't affect taxable profit or the accountable profit. The income tax expense for the Domino's Pizza according to its annual report is 45 million. The income tax expenses may not always be similar. The income tax expense may not always be similar to the tax rate times accounting profit. It is because a company has various sources of income which will be provided with different certain level of income. Furthermore, there will be various tax rate for various level of income. The effective tax rate and the accounting method is usually determined by GAAP or IFRS, which may not always be exactly similar with the treatment and the accounting tax rate with the accounting treatment or tax rate provided by authorized government tax code. Deferred tax assets and deferred tax liabilities recorded by a company helps us to communicate with important information. The deferred tax assets recorded by company will help us to understand that the amount of deferred tax assets has been already paid in the previous year have been made an advance payment or overpayment of tax in the previous year, which will cause deferred tax asset in the company's financial statement. Another one is a deferred tax liability. Deferred tax liabilities usually is recorded by a company when certain income is made by a company on account as an accounting income, but it is different from taxable income on the tax return. So these are the reason why the deferred tax assets and liabilities are recorded by the company. Another important thing to understand is that income tax payable, income tax expenses, and income tax paid may sound similar, but the three of them are totally different concept. First, we will look into income tax expenses. Income tax expenses is a amount determined by a company to be paid as a tax to the government. It is usually it is calculated under income tax statement on the taxable profit made by the company, and is usually a second last step before finding out the net profit of the company. It is usually calculated according to the generally accepted accounting principle and is calculated from the taxable profit. The next one is income tax payable. Income tax payable, as the name suggests, is a amount that should be payable in the future. This is a amount that is actually that should be paid to the government as a tax. It is recorded in the liability section of balance sheet and should be paid within a year. That's why it is a current liabilities. It is recorded as the rule of tax code, so it is in this way it is different from income tax expenses. Another one is the income tax paid. Income tax paid is recorded in a cash flow statement under the cash outflow from operating activities. So we are very clear that it's an amount that has already been paid as a tax to the government and has caused outflow of economic benefits. So it is completely different from income tax expenses and income tax payable, as it has already been paid and is an expenses that has already been incurred by the company. So the next one is the difference between the taxable between the temporary difference and the permanent temporary difference and a permanent difference. Temporary difference, as we have mentioned earlier, is a difference that occurs when there is a difference between the carrying amount of assets and liabilities and a tax base. It is reversible in the future, uh, because it is temporary in nature. When they are reversed back in the future, it will create deferred tax assets and deferred tax liabilities. It is also known as a timing difference because it can also occur when this transaction are realized as this transaction are realized by both financial accounting and tax accounting, but at a different time. So it can also be known as a timing difference. Also, the taxable temporary difference can be divided into two types. That is a temporary difference can be divided into two types, that is taxable temporary difference and the deductible temporary difference. Permanent difference is a difference that arise when there is a difference between the tax payable and the tax expense. It is never reversed back in the future, so it is permanent. That's why it is permanent in nature. As it never reverts back in future, it will not create deferred tax assets and deferred tax liabilities. It is much more simpler than the permanent difference, as it will only affect the particular accounting period on which it occurs. However, it will create difference between the statutory tax rate and the effective tax rate. So these are all the concepts that we need to understand before having a better understanding on income tax. Therefore, during this assignment, after an in-depth study on all this concept related with income tax, I got opportunity to have understanding of income tax in a better way. Through this assignment, one can have in-depth knowledge on income tax and how it is headed on annual and how it is treated on annual report and how it affects any company finances. Thank you.